Bingo. All right. Thanks, everyone, for joining us. This is the end of May, May 31st, Wednesday, 10 a.m. This is the 7th edition of our Fuse training. This is really why we called it Fuse training. This is about fusing together real estate and lending. Now, this webinar is more about how to use lending to your advantage. We never force people, certainly we encourage, but we never force people to use K-loans, our lending division. It's there as a tool for you. So if you ever want to bounce an idea or a scenario off of us, go ahead. Even if you're going to use another bank, if you've got a lender you work with, if you're comfortable with them, that's fine. But there are some things that they can do that some of them won't do, that we can do, that I want you guys to know the nuances and the basics of lending, and it will help you get more real estate deals. In fact, I lost a deal this week, and I'll get into that because of someone's stubbornness to use the lender that they chose, and they had a very, very high interest rate, and they just weren't going to change. So it's a good example of how it works for you, how it can work for you, and how it also cannot work for you or work against you. So lending is a really, really important component to real estate. It's the most important component, I feel. And having done these for a couple plus decades, both real estate and lending, to me, it's almost a symphony. They go together so well. There's so many different things that we have to know on the real estate side that's affected by lending. So, and some people choose to dive in a little bit deeper. Other people are just like, hey, look, that's the appraisal and all that good stuff. Very simple things. I want to get a little bit more detailed into it and also have you guys learn how to use this lending platform to your advantage. Real estate, as we all know, is really, really competitive right now across the country. We're seeing a couple trends, though, here late in May. We're seeing prices starting to stabilize. I read an article that used home sales were actually down last month. So that was the month of April. And so they're across the country, things are really stabilizing now. Most of us are all in the Pacific Northwest here. So the Pacific Northwest is still booming. There's still a ton of business going on up here, and it's still very, very competitive. So we have to give ourselves a competitive advantage. We have to find a way to do better when it is such a competitive environment. So, and that's what we're going to dive into. Okay. If this is the first time you guys have been on these webinars, you can go ahead and communicate with me on the chat room. So go ahead and type in a question. Alex is monitoring that. I see them. I'm monitoring them as well. Sometimes I don't look at the little chat box down in the corner of my computer, so it does come up eventually, and I'll get to your questions as we go. So feel free to dive in, ask questions through the chat room. I can't have you guys all talking at the same time, so everybody's muted at this point, except me. So that is it. Okay, so Fuse training. We chose Fuse. This is the genius of Alex, our marketing manager. We chose Fuse because there's a few things. It was not used by a lot of our competition, so the word was available for us to use and market and grow. But also because we wanted to fuse together real estate and lending. We wanted to show our agents something that other companies just don't show them. Traditionally, real estate companies are like, hey, we do real estate, find a lending partner, and they'll do the lending part of it. And as we know, there's a lot of commissions involved. There's a lot of money involved in that. So it's for some borrowers and some sellers, I mean, there's a lot of complications to it, and sometimes that arises. It becomes a real headache in a real estate transaction. And I'm going to try to give you guys an idea of how it works and try to alleviate those headaches in the future. And it's very effective and it's very powerful. It's a little complicated, but that's why we're doing the webinar, and this will be recorded, so you can go back and look at it a little bit later. And if this is your first webinar, I do take a lot of sips of tea and water, and I try to keep it casual. So Okay, so how do you use lending and finance to your advantage to get a competitive edge? Um, in the past, what's happened when you have these relationships between lending and real estate, the law allows for a lender or a real estate partner, one of the two partners, both partners, to pay 50%, up to 50% of marketing. So a lot of times you'll see advertising where you've got a real estate agent and you've got a lender with some bank, and they each have half a page or half of a section of a page. And so they're both paying 50% of that. And the law allows that. So the laws are very, very complex right now with the Dodd-Frank bill and the nationwide mortgage licensing system and all the things that have come about in the last 10 years. So there's very little nonsense in lending anymore, which is good. It protects the consumers, but it is more difficult environment to operate in, and the rules are pretty stringent. So a lot of times it'll just be like that. You know, a real estate company will say, hey, go find a lender, or here's a lender partner you can work with. They get the loan done. We like them. They buy us beers, you know, whatever it is. And that's fine. That's a typical relationship. The problem with it is that that lender now has paid for advertising. That lender has paid for marketing. That lender is now, they have to recoup that cost. And how do they recoup it? They charge the borrower. So, and they can charge the borrower in a couple different ways. They can charge the borrower by charging them up front. That's called borrower paid compensation. Or they can charge the borrower by basically saying, lender paid compensation. We will pay your compensation, Mr. Loan Officer, but in order to do that, we're going to raise the interest rate up to pay for it. So remember, in lending, there's always a cost. There's always a cost to that great interest rate, or a change, a product that sounds really, really good. Well, there's a cost to it, and typically that cost is in what we call price or in just the interest rate itself. So if it's fantastic, for example, 1% down program. We have a 1% down program if you have high credit. And it's your primary residence, well, you can put 1% down and buy a house. Well, it's actually a 3% down product, and the lender's paying the other 2% with a rebate. And they get that rebate by charging more interest, so a higher interest rate. So that's the cost typically. When you hear about a no-cost loan, that just means a higher interest rate, and I'll show you how that's priced out. But there's always a cost. So it's not just magic, or they're being, you know, all sweet and generous, and they're a sweet nonprofit that's going to not charge you or your borrower for the loan. No, they're going to charge you. They're just not going to charge you cash. They're going to charge it through what we call a rebate or yield spread premium, and that's in the higher interest rate. So that traditional relationship between lenders and real estate companies is fine. I mean, that's how 99% of real estate is done. And then they share leads with each other. They say, hey, we did a bunch of marketing. I've got someone that called up. They want to get pre-qualified to buy, and you're my go-to person on the real estate side. So, I mean, it works because you do get some leads here and there, but your borrowers suffer a little bit. And then it takes away that competitive edge that we can get. And that's really what this is about, is giving you a competitive edge. Going into a scenario where there's 4, 5, 6 offers all at the same time, and you've got an advantage over those other 5 or 6 offers. It's not a huge competitive edge, but it's enough to get you there. And that's usually what it takes. I mean, we know about escalation clauses, or if you don't, we've talked about them in other webinars. But, you know, people are doing things like escalation clauses, like bringing cash to the table to make up the difference for the asking price, between the asking price and a low appraisal. They're doing things like that. This is one more little arrow in the quiver to give you that advantage. Okay, so how do we get that advantage? So number one, you have to make sure that the lender doesn't charge very much. So the key to that is, if you're not going to use K-loans, make sure that whatever lender you're using, that they compare or match what K-loans will do. I designed and set up K-loans because I wanted it to be specifically for you guys and your clients. I wanted them to have such a good interest rate that we would be able to tell them, shop for your loan. Shop with any lender in America. The best way to get the best interest rate, the only way to get the best interest rate, is to shop with multiple lenders. So watch for that APR, the annual percentage rate, which is a cost of the loan. So someone might say, hey, this is a no-cost loan. It's not going to cost you any fees, but the APR is a lot higher. Well, again, the cost is in the higher interest rate. So you have to be very careful about that. And of course, you can always ask us questions, and we don't mind, me, Brandon, Louis, Sue, we don't mind answering those questions, even if it's just like, hey, you know, I'm at Umpqua Bank, and these guys are telling me this. Is that true? And we have no problem saying, yeah, that's true. Go ahead with it, you know, if you're comfortable with that. We just want to make sure that people are informed, that real estate agents are informed and understand how that lending side of the house works. Okay, so let's try some tea, and let's check our questions. Hey, Forrest. Hey, Forrest. You haven't heard that before, have you? Glad to be here. Good. Glad to have you. All right. So using finance to give you a competitive edge. I'm going to take you guys into a wholesale rate sheet right now. And some of you that have been in other trainings, you've seen this rate sheet before. It's today's rate sheet, so the pricing's changed a little bit. As an overall view on May 31st, 2017, mortgage rates are really good. They're not as good as they were 6 months ago before the election, but the election kind of threw them askew, and now they're coming back down a little bit. So they've really stabilized, and they've gotten better over the last month or so. All right, let's dive into this. Now, this wholesale lender, they've got all the products there. So just so you know, pretty much every lender has pretty much every vanilla product. A lot of them will carry portfolio products, and many of them don't. It just depends on who they are and whether they want to carry that note. But the way it works is to be able to sell a note to, and when I say note, I mean mortgage. When you're going to sell a note to Fannie Mae or Freddie Mac or FHA or VA or USDA, it has to be compliant with their guidelines. And as long as it's compliant with their guidelines, they can go ahead and sell that note and get their money back, plus whatever margins they've set with Fannie Mae, for example. So big banks, they're doing this every night. I mean, they're sending $1 billion, and they're getting $1 billion and $2 million back. And they do it every night, and those thin little margins, well, you think of, say they make $2 million a night, and they do that 30 days in a month. There's $60 million right there times 12 months. So there's big money in what we call a secondary market, but in order to sell those loans, it has to be very compliant and meet all the guidelines. So most lenders can do the basic vanilla stuff. If you ever have questions about who can't, we as brokers, we can go to different lenders or direct you to a lender that might be able to have a portfolio product that can help in a sticky situation. Okay, so if we look at this elite pricing, now this elite pricing is wholesale pricing. It's what we get and we can offer you. And by charging a flat fee, it doesn't matter the loan size. So if it's a $600,000 loan, we charge the same as a $200,000 loan or $1 million loan. That flat fee, salaried loan officers keep our pricing really down low. And by doing that, our margins are really low, and we can offer really, really competitive rates. So in this case, if they have, I'm sorry. Oh, in this case, we have elite. If you've got really good credit, in this case, you can kind of see down below, 740 plus credit score and 20% down in a loan more than $250,000. Well, that's an elite loan, and for a 30-year fixed loan on a 30-day lock, you get an interest rate of 3.5% right there. Look at that. Not only do you get a loan at 3.5% interest rate, but you get 0.413% back as a rebate to go towards your closing costs. That is the percentage applied to your closing costs. So if it's a $300,000 loan, 0.413% is $1,239 and 3.5% interest rate. That is really, really good. So remember that when you're pricing a loan or you're working with clients, don't just assume that the big bank or the bank with the
Muted. Unmuted.
Oh, are we unmuted now? Okay, I'm unmuted, it says, so good. Don't just assume because they're a big bank they're going to give you the best deal. Typically it's an inverse reaction. They give you a difficult deal. Now this is called pricing here, and so as we go up the ladder in interest rate, we get more rebate. Okay, you guys see that? So if I were to go to someone today with this really good credit and 20% down, and they said, hey, you know what? I don't want to pay closing costs, but I'm in a competitive environment. I'm in Seattle. It's got this beautiful bungalow in Wallingford. There's no way I can ask for closing costs, but I don't have the money to pay it out of my own pocket. I would say, great. Okay, if it's a $400,000 loan you're looking for, well, right there, you get 2.311% at an interest rate of 3.875. Now, that's a really, really good interest rate. And you're still getting 2.311. So your $400,000 loan at 2.311% is $9,244 towards your closing costs. And with us, that is probably more than we need. I could probably get them closer down to 3.75 and have enough money there for closing costs just because our fee is so low. Now to compare that, let's go to our competition here. You guys know this big bank. They've been very naughty lately, creating false accounts by the millions. So I don't mind using them. So we go into mortgage loans, and let's just kind of see what our competition is pricing stuff at today. Today's rates. Okay, so there we are. So a 30-year fixed rate is 4%. Okay, so that's their purchase rate today. So as you can see, and they've got their parameters down here, somewhere in one of these buttons. If you click on the buttons, you will find their parameters. I believe they're pretty 1% origination and a few other things, but pretty normal fees involved. But that's 4%. So there's our good pals at Wells Fargo when we're looking at a vanilla loan. So if we offered them 4%, we'd be able to offer more than a 3% seller contribution, or the equivalent of a seller contribution that the lender would pay in closing costs. So let's go back to our agenda. So that's one way to give you a competitive edge. And I'll kind of blend all this stuff together here a little bit. Let's dive into purchase power. Okay, so purchase power. How do you get more purchase power out of this sucker? I did a good example. It was a little while back, a few months ago, but it was in Renton, and it was a house that was roughly a loan of $350,000. And these people, they were stuck there. They had a debt-to-income ratio they could not change. They can't change their income. So they basically had a payment. They were quoted a payment at the local bank of $1,722 a month. That was their payment. They had to stick to that payment. And they could afford a $350,000 loan. Well, they came to me and they said, hey, Joe, we can only stay at $1,722 a month. We can't go higher than that. And I agreed. I got their information. That's as much as they can go. They were both on just simple salaries. And they had a certain amount of debt they couldn't alleviate. They had a couple car loans and stuff like that. But so they're at $1,722 a month, and I went into our rate sheets, and we were able to qualify them for a $371,000 loan. So $21,000 difference at 350, starting off at 350, with $1,722 a month payment, and they got $21,000 more purchase power. Fantastic. How does that help you guys in a competitive situation? Well, it's very simple. You can raise that price up a little bit and be able to offer more, use more of that escalation clause. So for example, you can get that escalation clause to go up to 371 and still have the same payment and still qualify. So if you're not familiar with escalation clauses, look back on some of our webinars or give me a shout. But an escalation clause just basically escalates the price up in increments up to a ceiling. So for purchase prices, let's say $350, well, you're willing to go up to $371 in $1,000 increments. So if the next best offer is $360, then you would be at $361. Okay, so pretty simple there, but this gives you an advantage. It can also give you an advantage both ways. I mean, so for example, we go back to our elite pricing here, and this $400,000 loan, for example, well, at 3.75, it gives us a 1.652 rebate, and that $400,000 loan, 1.652%, that's $6,608. That's a lot of money, and I know that would pretty much cover our closing costs here through K-loans. It would probably be a little bit more through other companies because, again, they charge a 1% origination fee, so that's $4,000 right there. Plus the taxes are a little bit higher, and those impounds will be a little bit higher. But our flat fee is $1,993 regardless of the loan amount. So good. So that way we basically are taking care of the closing costs at 3.75% interest rate, and we've got a 1/4 point less in interest rate. So they can either have more purchase power or they can have a lower payment. So let's take a look at the lower payment scenario. How would that work? So a $400,000 loan, that's our par value, over 30 years amortization at 4%, GI, zero future value. That's a payment of $1,909 a month, principal and interest, doesn't include taxes and insurance. Now if we do 3.75 GI, that's $1,852. Okay, so change the sign, 1909 minus, so it's the difference of $56 a month. So in this case, this scenario with a $400,000 loan, they basically would have their closing costs paid for, and they would have a $56 a month savings in payment with the lower interest rate. That is the power of lending. That is how you help your clients get to a better place. And again, the key is to shop loans. Don't just say, hey, you know what, I bank at Wells Fargo, so I'm going to run down there and get a loan. Well, you can, but you're going to be missing out on the competitive advantage that you have when you are able to find a lower interest rate. Again, I don't care if it's K-loans or not. Use K-loans to shop for other loans and find the best interest rate you can. Search the internet, look at different websites like LendingTree or Zillow Mortgage or whomever you want. But the key is to compare. And I think the best way to do it is to compare, get a competitive quote, and bounce that off of the competition. Say, hey, can you match this or beat that? Get them in a frenzy for your business. But by doing that, you're getting more purchase power, or you're eliminating closing costs, or you're doing both. So it's pretty powerful stuff when you think about it. Now, let's see. Oops, lost the webcam. Okay, we'll take a little break there, and let's see if there are any questions in the chat room. Anybody? Any questions? Sure, I'll even type it in. Questions? That's me. Brian, test. No, okay. You guys are absorbing this pretty quickly. Good. Now, this kind of pricing, this goes with pretty much every loan product, and I'll kind of show you how these loan products work. So that's the elite pricing. If they're going to do just a normal conforming loan, let's say they're going to do 5% down, then we would be down here in this normal conventional 30-year place. But we're still very, very close to 3.5% interest rate. That's almost a negligible, I would call that par, a negligible percentage. So on a $400,000 loan, 0.037% is $148. If I'm a real estate agent and I'm in that kind of territory, I would pay for that myself. But $148, it shouldn't really matter. That's what we call a buy down. So a lot of you hear about buy downs. Hey, what's it going to cost to buy down my interest rate? Well, this is it right here. This is the pricing scenarios and the pricing sheets. So if someone said that to me today, they said, well, I've only got 5% down, and my credit's not 740, it's 717, which is really good. So you still qualify for this pricing. Then I'd say, okay, well, you're probably going to be close to 3.5%, but it's going to cost you 140, 150 bucks. So that's buying it down. And sometimes it makes sense. Sometimes it doesn't. Sometimes, we get into this next increment and it's 1.037, and that's $4,000. And I tell people, it's probably not the best deal. It usually has to be kind of negligible, a quarter point or maybe 3/8 of a point, something in there, where it's a few $100, maybe $1,000, something like that. But unless they really want it, I mean, if they're savvy at finance, they understand how this game is played. And over 30 years, the lender is making so much money on the adjusted interest rate that getting a lower interest rate is the key to finance. This is how big banks make their money. And small banks too. Don't ever think a small bank or a credit union is some sort of benevolent neighborhood friend. They are just as, I don't want to say greedy, they are just as for profit, including the nonprofit credit unions, as the big banks. So don't let them deceive you into thinking that. So then these other products here, we've got, we've got, let's see, here's 16 to 20 year, 11 to 15 year, 8 to 10 year products. Right here is the 1% down product, 30-year fixed. So, and you can see that's a higher interest rate. So look at that, 1.349. Well, the interest rate is 3.875. So the interest rate is a quarter point worse, a quarter point to 3/8 worse. But you're also only putting down 1%. So there's, again, like I said before, there's a price to a product. Some people are like, hey, it's a 30-year fixed loan. How come I don't get 3.5%? Well, because you're only putting 1% down. A $400,000 loan, and you only have to put $4,000 down. That's pretty incredible, and still be under 4% for 30 years. So some really good products out there. And it is loosening up more and more and more. We've kind of gone over these conventional pricing adjustments when we did our finance webinar, so I won't get too deep into them, but it's complicated. Just so you know, there's a lot of factors involved in a loan. So it could be, you can see here as you go down lower in credit score, well, you take this hit to price that you wouldn't normally. So here's, let's say, a 90% loan to value. If you've got a 740 plus credit score, well, you only take a quarter point hit. But if you have a 655 credit score, you're taking a 3.5 point hit. Okay, so you get dinged quite a bit for bad credit, or if the product's a cash out, or if it's an investment property, or if the loan's in Texas or any of these other state adjusters. It could also be 2 to 4 units. Right there. So let's say they're buying a duplex, then we have to factor in this, and then like here it says not applicable. So we can only go up to 85% loan to value. They'd have to put 15% down with this lender. And so on and so forth. So as you can see, there's lock extension adjustments. So a quarter point there. So let's say they want a 7-day lock extension as the first extension. Well, that's going to cost a quarter point to price, not to interest rate, but to price. And so there's, you know, a $400,000 loan. That could be $500. So there's definitely a price to adjusting. And then elite lender paid mortgage insurance and elite borrower paid mortgage insurance. Lender paid mortgage insurance is a great product because really it's only about a quarter point hit to price to get the lender to pay mortgage insurance. So you can do 5% down or 3% down or 1% down and not have to pay mortgage insurance on that and still have a really, really good interest rate, you know, roughly around 4%. That's right there. That is the 1% down program. So I mean that's really, really good. Some of these other adjustments, I don't want to get into those too much. And then these are elite LIBOR ARMs. LIBOR is the London Interbank Offering Rate. So a lot of the loans and the lending rates around the world are based on this London Interbank rate. And then 7-1 ARM, 10-1 ARM, all that stuff. Don't want to get into there too much. DU Refi Plus, kind of a product from the Dodd-Frank bill that helped people that were underwater. We don't see it very often anymore because prices have appreciated in housing. Government products, then you've got elite FHAs, you've got jumbo FHAs, you've got VA fixed rate. So here's just a elite VA jumbo. Here's just a normal VA fixed. So 30-year VA fixed. They can have a credit score down to 620. And yep, they're down probably even below 3.5%. This is as low as the scale goes today, but once we price it out, we can go a little bit lower usually. And then USDA right there. So they're down around 3.25% for a USDA loan. And then government pricing adjusters. Government ARM products and so on and so forth. Jumbo products, and that is, it depends on the area you're in, but normal jumbo is anything over 324 and some change. In high value areas like Seattle, there's kind of a super conforming product. So in between that 424 and 5, I forget what it was from the other webinar, it was 515 maybe. Somewhere in there. You can always ask me if you've got that, but that's just about 1/8 of a point higher than a regular conforming product. So they want you to be able to get those borrowers into a good loan, and they boost up the value that you can, the loan amount that you can do. So anything over that 515 mark or so, then it becomes regular jumbo loans. And yeah, there's the ARMs and stuff like that. So that's a wholesale rate sheet. That's what we look at every day. And you can see up here, 10 a.m., 31 May, this thing's probably already changed. It's like the stock market. It's constantly changing back and forth, up and down. It's all pegged to the 10-year Treasury yield. And so we look at the bond market more carefully than we look at the stock market. But I can kind of gauge it a little bit when I'm looking at the stock market and the stock market is really, really weak, then typically I think interest rates are going to be a little bit better because the stock market, institutional money is taking their money out of the stock market and they're putting it into the bond market. Okay, Donna, I see a question. I gather the rebate is not required to be given to the buyer. Aha, good question. Okay, so the rebate, it's not required to be given to the buyer, but it certainly can't be given to us. It used to be, and that was in the heyday of the mortgage market, and what caused a lot of the mortgage meltdown is, I'll give you an example, Donna. You'd get into, let's say you're on this price rate right here, this elite 30-year, and let's say you quoted someone 3.5% and they got a 0.413 rebate, and that usually went to us. So if I was a good loan officer, and I used to be a good loan officer, still am, but when I was doing this full time 25 years ago, I'd say, okay, well, Mr. Borrower, I can quote you 3.5%. They were really happy about that. I didn't mention the rebate, and that's just something that was kind of a bonus to me. So we charged a 1% origination, and I ended up making 1.413 on the loan, and the borrower got the best interest they could get without having to come to the table with money and a buy down. So they were happy, I was happy, great. The unscrupulous ones, the ones that really, really jerked people around, they were the ones that they basically would, the borrower would come to the table to sign their closing documents. They're pretty excited. They think they have a 3.5% interest rate. They get to the closing table and they see their loan documents say 4%. Well, guess what? The unscrupulous loan officer locked them at 4% and got that rebate as well. So they charged a 1% origination fee and they made 3.007 on the backside for a total of roughly 4%. Well, you can imagine a $400,000 loan, that's $16,000 that they made on that deal. And it was crazy. There was a story of this Russian woman in Seattle when I was working, and she'd basically take immigrants that just came from Russia, the collapse of the Soviet Union. So this is the early 90s and stuff, and she would basically threaten them with deportation if they didn't sign those documents, and she would jack them all the way up to, let's say, 4.625 and make 5.749. So she'd make 6.749. Let's take a number. Let's see what that number is going to be. 6.794%, $27,176 on one loan with these poor immigrants that really had no idea what they were signing. They just wanted a house and they wanted to, they wanted a decent payment. So she lost her license, and but made a lot of money. She was one of those people that would trot around Seattle saying, I make $100,000 a month, and look at my cars and my boat and blah blah blah. Well, it all caught up to her. Actually, she was originally, I think, an engineer in the Soviet Union. But well-educated, smart enough, but unscrupulous as can be, and she would threaten them with deportation if they didn't sign. So on that tangent, I'll kind of bring it back in, but those are the kind of people that caused a lot of the mortgage meltdown. Those are the people that caused the government and the nationwide mortgage licensing system and the Dodd-Frank bill to not allow mortgage brokers to get paid this money anymore. But, so there's always a but. Take a sip of tea, and this, I have to take a sip of tea just because it's not bourbon, because sometimes I feel like I need bourbon when I'm talking about really how this works. So Donna, you opened up a can of worms, but we'll keep going just because it's somewhat interesting. I think it's really interesting. Mortgage brokers cannot make this rebate, but guess who can? The banks. So if you're a mortgage bank or a banking institution, you can still make this money. So that's why when we talk about that competitive advantage in providing a rebate to pay for closing costs, or lowering the interest rate to have more purchase power, big banks won't do it. If you go into Wells Fargo and you ask them, hey, I've got a competitive quote here from K-Loans. Can you match that? They would laugh. They'd say, no, we don't do that. We give you the rate we give you, and that's it. The reason is because they're giving that 4%, remember? So we'll go back to Wells Fargo. Oh, there they are, those kind, gentle souls. 4% interest rate. Well, guess what? At 4%, they're making that 3% on the backside. So they're making the 4% that the unscrupulous mortgage brokers used to make 10 years ago. That's what the banks are still making. That's how the Dodd-Frank bill was written by the big banks. And of course, our legislators never read it. So that's the one consistency we know about Congress, regardless of party affiliation, is they never read this big legislation. They just look at 20,000 pages and go, no, it's, but it's going to be good for the country. So that's what they did. The banks effectively wrote that legislation, and that's their little bonus. I don't know if any of you followed it in 2008, but after Bank of America got, I think it was $47 billion from the U.S. government, but some ungodly number, they had their biggest quarter ever, their biggest profitable quarter ever. Because they weren't just making this. They were allowed to make this money. They were allowed to recoup the money they lost when distressed properties were being sold. So the government was giving money on that side as well. But they also, in half the states in America, in recourse states, they were allowed to go after the borrower after they had been paid the deficiency. So yeah, bourbon and tea. So it's that's why I need the bourbon and tea, Lynn, because it's pretty crazy how they wrote the Dodd-Frank bill and what they still get away with. You know, you still hear about collateralized debt obligations. Those still exist. If you ever saw the movie Big Short or read the book, that all still happens. The securitization of loans that are all piled together, they're just piled together and pooled together in a little bit different manner now, but they're still sold as securities, as stock. And there still are recourse states. Now, Washington State is a non-recourse state. I believe Oregon and Idaho are non-recourse states too. It's a lot of the southern states, Tennessee and some of the southern states are recourse states. And what that means is that after even when a lender's been given the money, or they've been, let's say for example, they were paid by the government the deficiency. Someone owed, they had a loan of $300,000 and they sold their house for $250,000 in a short sale, and they were deficient $50,000. The government gave them that $50,000, and then in a recourse state, they could go after the $50,000 from the borrower until they declared bankruptcy. I mean, it just was pretty sickening what they were allowed to do, and still do, really, to this day. So if no one ever noticed, there wasn't a single indictment, a single arrest. It caused the mortgage industry here in America and around the world, basically caused the entire global economy to collapse. Yeah, thus the need for the bourbon. And I certainly was affected by that as well. I think everybody in the industry, if any of you have been in it long enough, you remember the pain of those days. So I'm hoping we avoid that again. It wasn't that far ago, wasn't that long ago. We're still starting to get into that territory, I think, a little bit, where prices are going up so fast, and they're subsidized really by these low interest rates that are, you know, they're really artificial. This is all part of the quantitative easing that went on to make sure that we could have affordable housing. Well, now it's become unaffordable even at these really low interest rates. You get 3.5%, 3.75% for a 30-year fix. That's fantastic. But you still have to deal with, you know, a starter house in Seattle for $550,000. You know, in Portland for $450,000. I mean, these are starter homes, 2-bedroom, 1-bath homes. So then you want to get into a mid-level house and it's $700,000, $800,000, $900,000. Well, what happens when these interest rates go up? Pretty simple question, and we all know the answer to that. And so that's one of my bigger fears right now. I want to make sure that, and I have no control over this, but I monitor it so that I can see what might be coming down the pike. I didn't earn these gray hairs for nothing. I mean, I've been through a bunch of recessions. I now have enough decades of business behind me to kind of go, okay, I can see something coming down the pike again. And so that's a little bit of a fear. That's why I'm actually happy when I see prices stabilize and interest rates stabilize and not be in this wild 10% a year appreciation market. I'd like to see it back down, Seattle, Portland, California, everywhere, down to a 2-3% appreciation per year, and interest rates stabilize at a good place. Might be 4.5% for a 30-year fix, something like that. But eventually, we're going to have to get out of this, and so that's one of my bigger fears. Okay, let's go back to our agenda and take a look. Ta-da! Let's see where we are. We talked about the lower payments. The second part of this really is to you know, how do we sell this? How do we earn business off of these interest rates? So we know a lower interest rate means more purchase power, and or it can eliminate closing costs, and or it can do both. A little combination of both. You know, pay for half the closing costs and bring the payment down a little bit. So we know that the market works that way. And any mortgage broker out there, sorry, again, guys, I have really bad allergies. If those of you that are in Spokane, it's like a yellow cake that's floating around in the air right now. It's absolutely awful because the ponderosa pines here just release this powder, and those of us with allergies suffer immensely. So I itch my nose a lot. I'm hoping it ends here in a few weeks. So we know that we have more purchase power. We know that we can do these things. And mortgage brokers can do these things. Banks typically won't. The mortgage banks might. So Quicken Loans is considered a mortgage bank, whereas let's say Wells Fargo, Bank of America, they're a retail bank. So they have different guidelines and different sets of rules. But Quicken Loans is the largest mortgage bank in the world by far. And I think they're the 5th largest bank now in America, period. So they're really, really big. But there's other regional players out there, and you guys have probably all heard of a lot of them. But typically they're just mortgage banks, and they can adjust their pricing a little bit as well. They can give you these rebates. They can manipulate what they're doing a little bit more of it. The big banks, like if you took a quote, I know I said take a quote from K-Loans and bring it over to the big bank, but they're just going to say no, we don't do that. We charge X amount, and we have this X interest rate, and that's it. So they don't have much flexibility there. But how do we win business doing this? This is an integral part of the Fuse training. This is what I want to really fuse together real estate and lending and integrate that into your sales and marketing platform. That's a tough conversation, and Alex and I we're recreating the new flyers that we want. They're going to be 3 or 4 bullet points, and that's it. We're going to keep them really simple. So you pop those in one of our nice folders with a nice business card of yours, and you're able to say, hey, look, I can give you a competitive advantage. Now, I almost never, I can't even really remember the last time I lost a sales deal when I go head-to-head with Windermere, Century 21, whomever, because I do bring this up. I do talk about not just my experience, but about what I can do to help them when it really gets down to the nitty-gritty in the negotiations, and how I can help them from a buyer's perspective or a seller's perspective save money. That's what they want. Save money, get the best deal they can, have the lowest payment they can. And that's what this is about. So let's start with the seller, because that's a little bit trickier. The seller, how do you sell the seller on this Fuse training and Kelly Wright Real Estate? Aha. It's pretty simple. What you want to do, you want to be well versed enough to know, again, what we've talked about here, that we train our agents at Kelly Wright how to recognize the opportunities and the options they have through lending. And so, Mr. Seller, what I can do is I can identify anyone asking for closing costs. They don't need to ask you for closing costs. You don't have to pay closing costs when those offers come in. Well, how are the closing costs going to get paid for? What if they don't have the money? Again, we know how, because of our training and our background, because we have melded a real estate company and a loan company, we understand that the lender will pay for the closing costs for a specific rate chosen. It's as simple as that. The lender will pay for closing costs for a specific rate chosen. Okay, I like that. So I don't have to pay it, and the borrower doesn't have to pay it. That's right. What else can you provide for me? Aha. We also know that there are lower interest rates by showing our buyers, or any buyer, even if they're with another company, by showing them that there are better options out there. We can qualify more buyers, people who couldn't afford your $350,000 house and might have been capped at $330,000. We can show them how to afford more house. So if someone comes in and says, hey, you're asking $350,000, and they come in with this sad $340,000, oh, I've got this pre-approval letter, and that's as high as I can go. Well, guess what? We know that they can go higher just by shopping for a loan. So we can earn you more money. We can save you money by making sure you don't pay closing costs, and we can earn you more money by qualifying more buyers to come to the table with a higher offer. Okay, let that sink in here for a little bit. So that's pretty powerful stuff. You know, that's one of those things where most people get a little bit shocked by that. And I think it's natural for a lot of real estate agents to go, I just don't feel comfortable talking about that. So, and what you can always do, if you get into a situation, I don't mind talking to them, probably be over the phone, but I can talk to them about how this works. And I don't mind showing them in an email. I don't mind showing them the rate sheets even. Show them that, look, it's real. This stuff happens. And it's not just the immense experience and this wonderful nature of our real estate agent that you're dealing with. It's the power that they have to help guide you through this process and help make you more money. Now, if you don't care about making more money, then I understand. Go with one of these other companies. They'll help you not make more money. Ha, try that one. So it's real. It's powerful. Is it going to make them fabulously rich? No. But it's going to give them an advantage. And that's what they're looking for, an advantage. Um, and really it's so simple. Now, I had talked earlier about losing a deal. So it was easy for me to sell the guy, but I lost it because, well, he panicked, number one. He's going to rent the house after 2 weeks on the market. And we've had 40 people come to the house. So I've done my job, and really, he wanted 175 here in Spokane, so just a little house. And it just wasn't that nice. It was just average. And I got a buyer to make an offer at 175 and no closing costs. I mean, how is that? And I was going to kick in some of my commission, and he knew that. And before I could even do that, he basically said, I want to take it off the market and rent it. So he panicked, a young guy. I know he's got, June mortgages coming. And so he panicked a little bit before I could really kind of help him help him get there. And so, and I asked the buyer, I said, will you switch lenders so that we can keep the price down and get your closing costs paid for? And they said, no, they wouldn't do it. So it's not all the time that a buyer is going to switch lenders. I think in this case, they had a relative who was the lender, and they're just like, no, I'm going to go with her, and I trust her, and blah, blah, blah. And that's fine. I mean, that is a case where it sometimes works that way, but at least when you're selling the deal, when you're getting the listing, you can at least say, hey, this is my skill set, and this is what we do. We've integrated a loan company and a real estate company to make sure you don't pay for closing costs, and we can also ensure that we qualify more buyers and at a higher price that can, potentially, that's the key to a lot of this, just say potentially make you more money. But then when they ask, how do you force a buyer to switch lenders, say we can't. We can only offer them what we offer them, and we try to get them to match. If they have a lender, try to get them to match what K-Loans offers. And we'll do a quick good faith estimate, send that over to them, and just say, hey, will you match this or even get close to it? But what we're doing effectively, just so you know, we're eliminating a lot of their profit. So that's the key to all this. We are eliminating a lot of these other lenders' profit. They've done marketing, they've done a bunch of stuff, they've wined and dined, they've done all sorts of things. So trust me, when they go and they get that loan, they're expecting to make $4,000, $5,000, $6,000 or more on the loan. So charging a small flat fee and bringing that interest rate way down, that's not in their best interest. So that's how we sell it to a seller, someone who's listing. So when you go on those listing appointments, make sure that you have the folder, have your card in there, and we'll get those new inserts done. In fact, I've got a list right here that Alex keeps reminding me of. Alex, God bless you. There's my list. I only have 2 of the 5 crossed out. Number 3. Oh, yeah, that's it, right? So the next one I've got to work on is exactly this, the bullet points for these new inserts. And we're going to match the colors a little better. We're really going to make it nice. We're going to print on real high quality cardstock and make sure that you've got that so that you can go in, and how you use those folders is, the Fuse program and what we're doing to help sellers and to help buyers, but also a letter from you. Just do it on our letterhead or do it on your own letterhead, but a personalized letter from you. And that goes a long way when you present that in a sales pitch. And you've got 3 or 4 other companies, and they're all going to say, especially the big ones, hey, we're really big. We're all part of, Realogy. If you guys don't know who they are, that's the publicly traded company that owns both Century 21 and Coldwell Banker and 1,000 other real estate companies. So people think those are different companies, and they're not. It's one big company with different brands. Kind of like Yum Yum that has Kentucky Fried Chicken and Taco Bell and all those different brands. So they're always going to say, hey, we've got, this huge marketing power. We've got big brand names. People want to buy from a brand name. We know that's BS. I have recruited most of you, and I have recruited probably over 500 agents, and not once has it ever come down to, well, we're not going to go with that person anymore because they're going to a company that's smaller. They always go with the agent because the agent they trust, the agent they know, and it doesn't matter where they hang the license. So we've seen that consistently pretty much 100% of the time. Okay, so we have just helped out a seller, and we got a deal, we got a listing out of it, and then you basically have to list it and do what you guys are good at and sell that house. But do remember, when you get those offers, Charlotte and I, we just talked about this a little bit with the offers. I don't mind reviewing the offers with you, but this is a busy time of the year. So reviewing every offer is going to be difficult. But if you have questions, specific questions on an offer here or an offer there, go ahead and let me know. But yeah, this is the part where you get the listing, and then after that, it's up to you to sell the house. And when these questions come in, when you do get those offers and there's closing costs on there, say, hey, we don't need to pay for those closing costs. We can still get this deal done, but the lender can pay for those closing costs. Let's figure out a way to get the lender to do it so that the buyer doesn't have to pay for it and the seller doesn't have to pay for it. And then if you're wondering, like, if you're nervous about that next step, let me know. If you're in that negotiating process, let me know, and I'll help you out. Okay, so we took care of the seller. Let's check our chat room, make sure there's no questions. Anyway, good questions. Donna, that was a good question. Lynn, Bourbon. Not after this weekend. We had a blowout Memorial Day barbecue at my house for the employees of the company, and let's just say the employees of Kelly Wright can drink. It's like, wow, that's a lot of booze gone. So, okay, the seller. Now let's talk about the buyer. How do you sell this to a buyer? A little bit easier for the buyer. The buyer's out there going, okay, I've just pre-qualified. I've got good credits. I've qualified for debt-to-income purposes. I've qualified with a $1,722 a month payment, and my limit is $350,000. So let's say they just qualified over at Umpqua or Wells Fargo. Say, great, come over to us. Let's see what we can qualify you for. So we pull credit within that 14-day period. Remember, that 2-week period is when they can have their credit pulled multiple times and only have it affect them as a hard pull once. After that, it's another hard pull. So when they're shopping, this is all kind of for their consumer protection. When they're shopping, make sure they shop for a loan within that first 2 weeks of when their first credit was pulled. But then they compare. And then again, we want to encourage every borrower in America to compare loans. It's just prudent. It's as simple as that. And you look like a really, really good advocate for them when you insist that they compare loans. Let them know that there's different options. There's better options out there. But the only way to find the best option for them is to shop. Always good advice, and they'll respect you for that. But how do we sell them on us? We're in real estate, and we're saying, okay, you're talking to a bunch of different companies. How do I help you? Well, number one, we always want to talk about, our abilities, and just on a basic sales level, you want to be able to relate to your buyer. It could be through a community you guys are in. Excuse me. It could be a community you're in. It could be a church. It could be school. It could be, someone you meet at the grocery store. Whatever it's going to be. But they're saying, okay, I'm going to shop for a few different agents and I want to pick the right one. Well, the sales is going to be up to you, but how this fuse can help them is you can show them that, okay, I want to help you shop for a loan. I want to help you shop for the best interest rates. We're going to look at multiple lenders, but also as we get into the negotiating process, I can make sure that you don't have to pay closing costs. And we can bring a stronger offer to the table because we have to in these competitive markets and make sure that the seller doesn't have to pay closing costs. And they go, well, man, I don't, I can't pay it out of my own pocket. And that's when we show them that, hey, the lender can pay your closing costs. Okay, so right there's a benefit. Well, at what cost? Usually the same interest rate that, or better, that the big banks are charging. Okay, well, that sounds pretty good. What else can you do? Well, if you've got lots of money and you want to pay the closing costs, then we can also get you more purchase power. By shopping for a better interest rate, you can establish a higher level of purchase power. You can basically buy more house for the same payment. Well, how do I do that? It's in the interest rate. Shop, shop, shop. Compare, compare, compare. Where do I start? Well, let me have you start with K-loans, and then let's go together. Let's shop for the competition and see if they can match it, beat it, or whatever. You're going to earn their trust if you get them to shop around, especially in this competitive environment. Tell them that story that the broker did a deal in South Seattle with that $350,000 mark that they were quoted by a big bank, and for the same payment, we went up to $371. So $21,000 more in purchase power for the same payment. In this competitive environment with 5, 6, 7 different offers, that is going to help. Okay, pretty simple there. More purchase power is going to help the buyer. Now, of course, there's all these different products of 1% down, 3% down, 5% down, no mortgage insurance, all that kind of stuff. We go down to a 580 credit score with 10% down, FHA. So there's all these different products that we can offer, and we do not mind at all. If we can't do it, we'll find a lender that can through our experience, who's going to be the best at a certain loan. We understand that you guys want to get the deal done. You want a real estate commission, and we want to help you get that real estate commission. So that's part of our focus as we are here to help you. Okay. So that's how we win the business. And we'll have those bullet points on this flyer as well. It's just going to be a one-page flyer this time, not two. And it's just going to talk a couple bullet points about buying and a couple bullet points about selling. Okay, let's look at the chat room. Any questions? Oh, sorry, Guy and Lynn. I missed a bunch of them. Let's go back. Can borrowers shop for mortgage loans without harming their FICO? I think I just answered that one. Within the 14-day period. It will be harmed once. It will be a hard pull, but it's typically 5 points. If you have a 750 credit score, it goes down to 745. No harm there. You're not going to get any better pricing because of that. And that's what our FICO scores are for. This whole thing's built for shopping for a house primarily, and then a car and some other consumer loan products. But it's really about building this thing up and up and up and up so that you can buy a house. So sometimes I hear that people are worried about their credit and they're trying to buy a house. I'm like, this whole thing is built for people to buy their house. Let's see, Lynn. Recently told 30 days, which is correct. Credit things. It's 14. It's not 30 days. Yeah, don't believe that. That could be by someone that, let's say you're 3 weeks out and they're like, hey, let me pull the credit so I can get this loan. There's a lot of nonsense out there. I'm probably the only mortgage broker or owner that is pretty honest with people, that just says, look, go to this place. They've got a product that could help you out. I turn away a lot of stuff. Mostly it makes it easy, and there's a lot of freedom in having such small margins. So we don't make a lot of money on a loan. So if someone doesn't want to do a loan with us, I'm like, well, that's fine. But I'm still very interested in getting them the best deal so that you guys can close deals. That's really our primary goal. And then, of course, we want to make some money as well as a secondary goal. Thanks for having the mute on, Alex. It's getting loud out there in the bullpen. I haven't heard anything, so yeah, the mute's great. Okay, any other questions in here? Nope, 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 nope. Okay, good. All right, so that wasn't too long a webinar today. I do want to finish on one thing, so professionalism. I touch base on this once in a while, but I want to reiterate it just because I think it's really, really important. The market's gotten so heated that we're seeing emotions, really rise up, and the emotions can really take over people's common sense. Sometimes I'm like, what are you thinking? But I get those calls a lot, and I get them every day. I mean, I had one yesterday. A Seattle Century 21 agent was PO'd at one of our agents because they couldn't get a hold of them. And I'm like, come on. I mean, so they didn't call you back in an hour. Why don't you give it a little bit of time? The emotions are very intense because we know there's a lot of money on the table. We know there's a lot of emotion because it's not just money, it's a home, and especially if you get people nesting or, this is where they're going to live. So especially if they really, really love a place. I mean, so the emotion's running high. Be professional. We're the ones that are supposed to bring the emotion down a little bit. We're the ones that are supposed to have that professional demeanor. And when we start screaming at each other, the other agent or the clients, I mean, it doesn't help anything. So I'm kind of telling this to everybody, is try to maintain a very professional level, a very professional demeanor. It's important because even though they're emotional, and sometimes they say things that maybe even might be hurtful, I typically let it slide. I understand the emotion involved. They're very nervous. They might not get a house. You have to do an extension. The seller could say no. There's all sorts of things that can happen along the way, and so we really have to guide them through this minefield that is real estate today, because there are multiple offers and there are high prices, and people are stressed out because they've got to have two incomes and maybe even three to get it done. I mean, we see that a lot with other family members moving in and helping to pay that mortgage. So, and it's tighter spaces. They're buying smaller homes, and there's a lot of stress out there. So try to be as professional as you can. Take a deep breath when everyone is screaming. It's not the end of the world. Other houses do come along, and a lot of deals can be salvaged. Sometimes I see real estate agents kill deals because they're so hard-headed, or they're coming at it from a different approach, and sometimes they don't get back to people as well, so a deal dies. If we're really professional and we're really good at our jobs, we will get the deal done. If it's meant to be done, not always, but if it's meant to be done, we'll get it there. And then we got to keep everybody, I don't want to say happy, but keep them on track. Okay, just keep it moving forward. And if you need help with that, you give me a shout. That's what I'm here for. Okay, one last sip of tea, and then let's take a look at a chat room. Everything looks pretty good. No more final questions? Okay, thank you everybody for joining us on today's webinar. I love this stuff. I love being able to show people a better way to buy real estate. It's competitive out there, but this will give you an advantage. Look at what's coming down the pike. We'll try to get those. We'll let people know when we go to print those inserts, and then we'll try to get them out to everybody. But especially with our new order fulfillment center, you can just take 50 of them. You can have them shipped right to your house. If you're not aware of that, our online store right now has order fulfillment where they've got folders and cards and signs and mugs and cups, and soon to be jackets, really nice jackets and sweatshirts and t-shirts and polo shirts and hats and all sorts of stuff. So we really want to have as much stuff in that store as possible. And the fulfillment center, they just box it up, pop your address on there, and they ship it out to you directly. So pretty cool. Not without its issues. We're still kind of working out a few of those, but for the most part, it's working better now. And we'll get those inserts into the order fulfillment center here as soon as we get them printed. So thank you, everyone. I hope you learned something today. Next week, we're moving on to real estate inspections, appraisals, and valuations. Again, it won't be a long one next week. We're trying to keep these a little bit shorter than the first couple ones were like 3 hours, and that was too long. So we want to keep them down to an hour and a half. And so I think we're hitting our goals there. Okay, everyone have a fantastic week, and I will see you next week. Thank you.
All right, thanks, Joe.